All right. Welcome back, guys. Welcome back. If you're listening on the podcast, welcome back. If you're uh, watching this on YouTube or on Instagram or TikTok, wherever, welcome back. So I'm here with Rebecca. She's our student. So we're still doing our one-on-one tutoring. Well, this is part of our live webinar. And as I said in previous episodes, if you listen to those, this is 100% free. Free means zero. So we do live training here for students. Sometimes we have one student, sometimes we have up to 6, 7 students at once. So if you want to be a part of one of our free trainings, we're going to have the link in the description. So click that link and register. Just remember to confirm your registration. The other thing to let you guys know is we're pre-selling our courses, right? So pre-selling our courses, meaning that you can purchase our self-study courses in advance. So if you do that, you're going to end up saving about 70%. That's about $116, which is a lot of savings. And then not just that, but we also have our affiliate program. So you could sign up to become an affiliate. We're going to have all those links in the description. You can sign up to become an affiliate, and as an affiliate, you refer our courses to people. And if if someone makes a purchase, it can be any of our courses, one-on-one training, self-study, you get 30% of the purchase price. So that's another way to make some extra money on the side. Our average affiliates make about $725 a month. Not bad, right? So if you're interested in that, find a link in the description. Okay, so let's get back here. Hey, if I don't advertise our own product, no. I'm not going to advertise another company's products, right? So that was just a little plug for our self-study courses. Don't get mad. It's free, right? So hey, if it's free, we got to put a little plug there. uh, yeah, if you are paying for this, I swear we're not going to even waste 2-3 minutes trying to promote anything. But because this is free, well, you have to be a little patient. Okay, so we have our student, as I said from last time, we have Rebecca. She's from the great state of Nevada. So she's joining us here. Rebecca, you want to introduce yourself again for those who didn't watch previous episodes?
Yes, I'm Rebecca, and I am from beautiful Las Vegas, Nevada, and I'm excited to be taking this course so that I could pass for my insurance, life and health insurance.
All right, guys. She's living in adult Disneyland. We have the Disneyland for kids, and then we got
right. I get a whole city.
So okay, so we're happy to have you, Rebecca. We look forward to helping you pass your insurance exam. So we're still on group life insurance. Last one we stopped on was conversion, right? We said that if you have group life insurance, you have the right, if you leave that group, the most common group life insurance is employee group, where you're an employee for a company. If you leave, you have the right to convert that group life insurance to an individual life insurance policy, but it's within a set period of time, and that is 31 days. All right. So just to recap, under what like in what situations or like what requirements have to be met before you can convert the group life insurance to an individual life insurance?
What sort of requirements have to be met in order to change from group?
Yeah, in order to convert your group life insurance to individual life insurance, like what conditions must be met?
So it's got to be less than what the policy is worth?
No. So in order to change, in order to change from group life insurance, no, to convert from group life insurance to an individual life insurance, you must either quit your job, right? Retire.
Get terminated, quit, right? Terminated,
Yeah,
quit your job, or retirement, if I'm not mistaken.
those are the conditions.
Yes.
All right. So we're saying that to convert your group life insurance to an individual life insurance, you have to be separated from that group, right? That means you have to either retire, get fired, or quit, right? But as long as you're with that group, then the conversion privilege does not apply to you, right? Into an individual life insurance. Now, there's only one circumstance in which you can be able to convert from a group life insurance to an individual life insurance while you're still on your job, right? And this is something that a lot of people don't know about. But if you've been an employee for at least 5 years, right? You've been on the job for at least 5 years, and your employer decides for whatever reason to cancel insurance, right? Like, okay, we're not going to offer life insurance anymore to employees, right? So that means they're getting rid of the insurance plan altogether, right? If you've been with your employer for at least 5 years, then even though you're still with the employer, but because they're getting rid of their insurance, then you have the right to convert to an individual policy. If you've been with the employer for less than 5 years, then that right does not apply, right? You don't get to convert. So the only exception where you can convert your insurance when you're still with your employer to an individual life insurance is two things have to be occur. Number one, you have to be with that employer for at least 5 years. Number two, your employer is getting rid of the insurance. Hey, if I'm still with you and you're getting rid of the insurance and I've been with you for at least 5 years, I think I should have that right to convert to an individual policy. So that's the only exception. Any questions?
No.
All right. So that's just a little bit for conversion. And the most important thing for group life insurance for conversion is that date. So within how many days does someone can someone convert their group life insurance to individual life insurance after they quit their job or leave their job?
31 days.
Perfect, 31 days. So if they're going to ask you a question on the conversion for group life insurance, more than likely that will be the question I'll be asked. The other question I will be asked is if you're converting from an individual life insurance policy from a group life insurance to an individual life insurance policy, do you have to show evidence of insurability? Yes or no?
No.
Perfect. No, right? So as long as you convert within those 31 days, you do not have to show any evidence of insurability. All right. That's good. All right. So now we're going to talk about our next topic here. We're going to talk about you have two different types of group life insurance. We talked about this in the overview. We have non-contributory and contributory group life insurance. So tell me everything you know about, or you can compare and contrast the two, the difference between the two. I'm sorry, I'm putting you on the spot here.
I know. Okay, so if I can remember correctly, non-contributory means that 100% of the members must be covered or must be under the non-contributory. Contributory, then at least 75% of the members must be covered.
Perfect.
Non-contributory means that the employee or employer pays for Oh God, I think I want to say all of the,
Perfect.
all of something, but I can't remember exactly
No,
what it was.
all of the premium.
Premium, it was a premium. That was
Yeah, all of the premium.
perfect. And then
Mhm.
contributory, I'm not mistaken, then they pay 25%.
Well, the percentage can vary.
Okay.
It
Okay.
doesn't matter. But the most important thing is the employer, the employee has skin in the game, right? So is what contributory? Why? Because the employee,
It's a contributing.
right? Whereas if it's non-contributory, the employee is not contributing anything. So it's when the name just applies to what the employee is doing. If the employee is paying part of it, the employee is contributing. So it's contributory, right? And if it's contributory, then the insurance company will require the employer to have at least 75% of the employees covered. If it's non-contributory, then 100% of the eligible employees have to be covered. Why? Because it's free. Just think about it. If something is free, why won't everybody be part of it, right?
Right.
So that's the difference. So if you know those two, again, those are the two main differences. So if they're going to ask you a question on that topic, more than likely, that's a question that will come up. So let's just do some quick practice questions here. So number one, you can tell me what the answer is. It says a contributory plan has which one of the following features? So what's the answer?
D.
D.
Wait,
D as in dog.
hold on. C. Sorry.
C. Perfect. Yes. C. Eligible employees pay a portion of the premium. That's true. So contributory just describes, it's just describing whether the employee is paying premiums or not. That's it, right? It's just about the premium payment. So if the employee is paying towards, paying, it can be, the percentage really doesn't matter. It can be 5%, 20%, 50, it doesn't matter. But as long as the employee is paying some of that premium for their group life insurance is considered contributory, right? Because you're contributing. If it's non-contributory, that means the employee is not paying anything, right? They're getting it free. And if you're not paying anything, well, everybody has to be covered. If you're going to pay something, we understand some people are cheapskates, right? They'll be like, that's too much money. I don't want to get life insurance on my family. That's fine. So the insurance company say, okay, because we understand some people will not want to pay premiums, or they don't want to be a part of it because they got to pay money, take money out of their paycheck. That's fine. But now we're going to, instead of requiring every employee who's eligible to be a part, now we require only 75% of eligible employees for you to cover them.
Understood.
So we know it cannot be D because D says employers must enroll 100% of eligible employees. So that is describing a non-contributor. But this question asks for contributors, so C is the correct answer. Okay, so let's move on here. Let's go here. And just keep in mind, I mean, most people will know this because if you work, you kind of know, but most of the time, part-time employees are not covered by, whether it's health insurance or life insurance, any kind of benefits, most of the time, part-time employees are not covered. And then when you have children on your group life insurance, your dependents, they're eligible, to get, for them to get coverage also. So most states will allow your dependents, again, it varies state by state, but they can get, sometimes it's up to $2,000 of coverage. So your dependents, your spouse, your kids, sometimes they can get either $2,000 or up to 50% of what you got. So if your employer is covering you for maybe $100,000 life insurance, on your job, then your kids, your spouse can get up to 50,000, right? Coverage. But again, it depends on state law. Some states will say 50%, some states will say $2,000. Like Texas, I think it's $2,000. So it just depends. All right, let's come here to question number 2. Which of the following statements about non-contributory group life insurance is not true? So what's the correct answer?
So which one is not
negative?
true?
Yeah, it's not true.
Okay. A.
A, employee pays none of the premium.
So if it's the negative,
It says not true, right? So that's a true statement for non-contributory group life. The employee pays none of the premium. Yes, that is true. But this question is asking us what is not true. So we're looking for the false statement.
I hate these. I absolutely hate these. So it's not true with non-contributory.
Mhm.
It's not contribute. You don't contribute 100%. I hate these. These really mess me up.
Mhm.
Okay, they don't have to submit.
So we're looking for the false
Sure.
statement.
Right, so they don't have to submit. 100 participation of the eligible group members is required. That is true. Non-contributory, okay.
Mhm.
So I'm thinking B.
B as in boy.
Right.
Yes. B is false, right? Because it says an employer pays 75% of the premium. No. So that means the employer is paying a percentage of the premium, right? But we said that anytime the employer and the employees split the cost, like the premium, is considered contributory, right? But this is asking which of the following statements about non-contributory group life insurance is not true. So we know that B is not, B will be the answer because an employer pays 75% of the premium for non-contributory group life insurance. That's false. The employer pays 100% of the premium. So on your exam, they say 100% of the premium or all of the premium all means the same thing, but the employee has no skin in the game. The employer pays 100% of the cost of the premium.
These always get me. The ones with the nah and the faults and the
Yeah.
We
So
gotta
we
get
know,
to it.
yeah, so we know C cannot be the answer because C says 100% participation of eligible group members is required. Yes, that's true. D, the participants do not have to submit evidence of insurability. So that is for all types of group life insurance. So once you're eligible, most employers will have, a waiting period. It's usually 90 days. So if you've been on a job, after 90 days, then you can get group life insurance and all of that. So you don't have to go and prove that you're insurable. No, as long as you're eligible, you don't have to submit any evidence of insurability. All right. So let's come here to question number 3. So I know this may be a little confusing. So the easiest way to remember it, because when you have two opposite things, sometimes people get them mixed up. The easiest way to remember is just learn one and just know that the opposite is true, right? So you can learn, let's say, everything about contributory. Okay, the employer, has to cover at least 75% of eligible employees, and the employee pays a portion of the premium. So you learn everything, and then you don't have to go and learn about the other one, right? Then you just take the exact opposite to be true for non-contributory. So in that way, you don't confuse yourself. So just learn one, and on the exam, you know that, okay, if it's contributory, the employee pays. So I know that non-contributory has to be the opposite. So I don't have to worry about that. But if I'll study this one, and anything for non-contributory will just be the opposite. That's the easiest. All right, let's go to question number 3. The employee has control over which of the following in a group life insurance plan?
B, choosing the beneficiary.
No, that's not B. That's C.
Oh, sorry.
No, that's D.
D.
Yeah, D. Yeah, D. Yes. Okay, choosing the beneficiary. Perfect. So the employee has control over choosing the beneficiary. But everything else, who chooses the insurance company is the employer, right? Who has the master contract? The employer. Who decides the mode of premium payment? Mode just means frequency, right? So on your exam, if you see mode of premium payment, just know it means frequency of premium payment. Now, while we're on that, what are the four modes? What are the four modes of premium payments?
4 modes of premium payments.
This will be on your exam.
Oh, it's a good one. So it probably would be, I'm assuming, annual.
Perfect. Annual is one.
I'm assuming oh God, what is it called? When you actually show up at the place where you're getting, shoot. Oh, a monthly?
Yeah, monthly. You got okay. 2 more.
Monthly.
Again, mode of premium payment.
I want to say not biannually, but like every 6 months.
Perfect. Yeah. No.
What is that called?
Well, that's biannually.
Yeah. Oh, it is. Okay. So biannual, and then
last one is quarterly. So,
okay.
You can pay every month, right? Again, mode of premium payments just is about frequency. So how frequently can you pay your premiums, right? You can pay either every month, you can pay every 3 months, which is every quarter. You can pay every 6 months, which is on your exam, they may say semi-annual, or they may say biannual, or it's the same thing, or you can pay annually. Okay.
For that, would it be like, let's say the premium is $1,000. Is it going to be the $1,000 biannually, or is it going to be, somehow they'll say, well, to save you money, if you pay the annually, it'll save you more money if you do annual.
Yeah. So usually what they do is whatever your monthly payment is, you just multiply that by, if you pay every 3 months, it'll be 3. If you pay every year, about 12. Yeah.
Okay. So they don't save you money if you decide to go one way or the other.
Perfect. You raise a very good point, and we'll cover that. Well, we'll cover that in our self-study course in chapter 2. So I'll just touch on that because you asked that question. So anytime you're paying, well, just know that there's an opposite relationship, right? Like a seesaw. When we're kids, well, I'm not sure if you roll seesaw, but when we're kids, we have to ask, we used to ride seesaw, right? So your friend sits on the opposite end. When your friend goes down, you come up, right? You go up, your friend comes down, something like that. So it has the seesaw relationship. So what that means is when you decrease the frequency of premium payment, that means, let's say, instead of paying every month, you pay every year, once a year, right? So when you decrease the frequency, again, mode of premium payment just means how frequently you pay your premium. So when you decrease the frequency, right? When you decrease the frequency No, I'm sorry, it's not opposite, it's the same, not, scratch that. When you decrease the premium payment, then you're going to decrease the total amount of premium, right? So let's say if you're supposed to pay, let's say your monthly premium is $100, right? And so 100 times 12 is 1,200, right? So if you pay monthly, you're going to pay $1,200 every year, right? But now you say, you know what? I want to pay every year, right? Once a year. So now instead of paying 1,200 total every year, if you pay annual, you say, okay, your annual premium, instead of being 1,200, your annual premium will probably be 1,100 or $1,050, right? So what I do, because for those of you who don't know, I'm also a life insurance agent. When I'm not teaching, I'm helping clients. So what I recommend to clients, if you can afford it, if you got money, you can afford pay annual premium because you're going to save money. The other way to think about it, when you making installment payments, you always end up paying more than someone who's just buying it upfront, right? So if you say, oh, I'm going to pay for this item, let's say I got a TV and I'm going to pay a little installment on it, every month for 12 months, you're going to end up paying more than someone who just buys that TV upfront. So just know that, know that the frequency, the more, frequently or the higher the number of installment payments, the more money you're going to end up paying total.
Okay.
Okay. Yeah. So scratch that seesaw relationship.
Right. I didn't hear that.
Yeah. So they go. All right. So all of that goes hand in hand. So we said D was the correct answer. That's correct. All right. Number 4, when is a premium tax deductible? Again, we'll get into this more when we talk about taxation of life insurance. But
totally gonna guess on this one. Let's see if I guess right. So
yes. Yeah, when is a premium tax deductible?
Oh wait, I might know this. Premiums for renewed.
Mm-hmm.
D.
D.
Yes.
Premiums paid by an employer on a 50,000 group term life insurance plan for employees. Correct answer is D. Yes. So that was good. So just remember, anytime the employer, right, is paying premiums, right, it's always tax deductible. Why? Because it's a business expense, right? But individuals cannot deduct your premium. They cannot deduct their premiums for life insurance, right? Now, I know some people may be like, hold up, but why is the business going to deduct that on your taxes? But me, as the individual, I'm not allowed to deduct it. That's not fair. Well, when you look at it, the reason they do that is because the death benefit is tax-free, right? So yeah, you're not going to get any tax break. You're not going to get a write-off your premium payments. But when your beneficiary gets that death benefit, it's tax-free. I would rather get 500,000 or 1 million tax-free, than try to get a tax write-off for $50 or $100 a month premium payment. And again, we'll get into the taxes a little bit more later on. But while we're on this, when it comes to taxes, people get very confused, and that's one of the confusing part of the exam. So the best way to help you remember any question that has to do with taxes, right? You can just let me annotate here. So for those of you on the podcast, I'm sorry you're not going to see this. That's why you should. This is why you should sign up for the live webinar so you get to see all of this. So you are missing out. Check the link in the description, and you're going to you can see that to register for the webinar. Okay. So here you can see here, right here. So anytime you okay. All right, so I got your message. All right, so for taxes, you're gonna see here that Uncle Sam, I just remember that Uncle Sam always has to get his cut. You know, you can either pay taxes before or you can pay taxes after. So here, you just write here on your exam, you see any question that has to do with taxes, just just write before, jeez, I don't know what's going on with my mouse here, and after. All right. Yeah, so before and after. So all right, that's rich. So yeah, you ask yourself, is taxes, if the death benefit is not taxed, then that means the premium is not going to be tax deductible, right? But
Wait, one more time, say that again.
if the death benefit is not taxed, then the premium cannot be tax deductible, right?
And now death benefit is not
Not tax deductible.
if the death benefit is not taxed,
Mhm.
then death benefit is not tax deductible.
Oh, no, so again, yeah, we'll come here. So did you pay tax on those premiums you pay? Did you pay taxes on those premiums?
No. Or do you?
Mhm.
You do?
No, the premiums for life insurance are not tax deductible, so you don't get to claim down your taxes.
Right.
Yeah, so those premiums are not tax deductible, right? So they're not tax deductible. You don't get to pay you don't get to deduct that on your taxes, right? So
Right.
because you're not getting that deduction on your taxes, that's why you get the death benefit tax rate. If you are getting that deducted on your taxes, then the death benefit will not be tax free. Because remember, Uncle Sam has to get taxes, and I know you got to go. I think we just got one more question after this, then we're going to end it here. But well, I'm going to stop you and see what your confusion is, because I see a look on your face like you don't get
Yeah,
it.
very, very confused on this one. Okay, so I'm trying to think
Mhm.
if you said the death benefit is not taxed, then you will be taxed. One more time.
Okay. So because the death, okay, well, the easiest way to think about it is just know that you can never be taxed twice, right?
Okay.
The same way, the government cannot, they cannot, they cannot try you twice for the same crime, right? Uh, so um, because the death benefit will not be taxed, right? We know that. For your exam, know that all types of life insurance, it doesn't matter whether it's group life insurance, modified endowment contract, whatever, is the death benefit is never taxed.
Okay.
Because the death benefit is never taxed, that is why the premiums are not tax deductible. Okay, so premiums on individual life insurance or whether it's group life insurance, were premiums that you as the insurer, the insurer or the policy owner pay are not tax deductible. But for the business, if the business is paying it, it's tax deductible. But if
Right.
you
Okay. I think that's where I was getting it confused. Got it. Okay. That makes more sense now.
all right.
Okay.
So all right, let's move on because I got your text and you see you have to run. So let's get here. Okay. So I think this is the last question, number 5. Usually group life insurance policies are written as, what's the correct answer? And we talked about this yesterday.
I want to say D.
Usually group life insurance are written as group whole life. Nope.
No.
Mm-mm.
Okay, so
That's
group
not the answer. So
insurance.
now you're left with A, B, and C. You have a 33% chance of getting the right answer.
Usually group life insurance policies are written as increasing, no, so A.
Perfect. So just know that group life insurance policies are always written as annually renewable term insurance, right? So that's it. I think this is the last one. Who is qualified to receive a certificate of coverage under a trustee group life policy? Who is qualified to receive a certificate of coverage under a trustee group life policy? What's the answer?
D, employee.
Perfect. Good job. Because you see, anytime you see certificate of coverage, the employee always get the certificate of coverage, right? But the plan sponsor, right? And the plan sponsor is pretty much the company or the organization that's that's getting the insurance. They get a master contract or they get a master policy. So labor union is a type of it's a type of group. So the plan sponsor will be the labor union employer. So it cannot be the employer, it cannot be A. There's nothing called board of trustees. So we know correct answer is D. All right. So yeah, if you want to take a screenshot of this, because of time, I'm not going to go into all of these because I know you got to run. But you can take a screenshot of these, so you know that these are the different types of organizations that can get group coverage. So we say multiple employee group, labor unions, single employee group, trade unions, credit debit groups, fraternal organizations, trustee groups. So you can just take a picture of that, and then we can move on. All right. Let's see how many questions we got. Okay, just one more. I think this was 7. All right. So what's the correct answer for this one? What is one prerequisite for a corporation or organization to obtain coverage under a group life insurance policy? What's the correct answer?
Group directors must have at least 20 employees who are sworn members other than acquiring your insurance. D also.
Perfect. Good. Yeah, I think you got almost 90 something. You only got one wrong. Good job. So group was formed for a purpose other than acquiring insurance. That is true. You must get your that group must get the insurance, not well, it must be formed for a reason other than just getting insurance, right? So know that D is the correct answer. Look at that. All right. Good job. So we're going to pick it up next time. Then we're going to talk about retirement plans, different types of retirement plans, 401k, Roth IRAs, rollovers, all of those things. So before we part ways, any questions? Questions? Nope. Any questions on me? Okay.
No questions, comments, or concerns. Very excited.
All right. So thank you very much for your time, Rebecca. And we're going to see you next time here. And for you guys who are listening, thank you for listening. And we're going to see you in our next episode. Thank you.